So we finally made it. We got the new quant deck released with the new Aries, RQF, and Astrius strategies, new and improved. Everything is better. This is These are the stats. If you guys were
Yeah.
curious, this is the yearly stats with a 12-month alpha versus SPX. There's only been two periods of slightly negative alpha since 2017. Obviously, we can't track since the inception of RQF because it is a 12-month trailing alpha. So we can't trail 12 months starting in 2016. But starting in 2017, it's been more or less positive alpha, uh, very exceptional positive alpha. A lot of it being over 100% of alpha, which is insane.
Yeah. And like, I think the most important thing to emphasize here is the RQF is the radar quant fund, right? And the RQF does encompass Bitcoin, but these are returns, especially the trailing 12-month alpha return against the S&P. This is assuming that the RQF is on somewhat of an 80-20 split, 80% in Aries and 20% in Astraeus, which is the Bitcoin model. So like this this return map here of alpha is not Bitcoin dominated. It's obviously being helped with Bitcoin, but it's not like this strategy is heavily weighted in Bitcoin.
Yeah, and it's cool to see the yearly performances. So Aries is the green, and Aries has had one red year in 2022 where it was just slightly more red than the S&P, which is insane because we're able to capture the upside with the leverage that we're using. And when it is a bad year, which they always happen, you can't really avoid it, we don't take that leverage downside with Aries. It's able to avoid as many drawdowns as possible, and we draw down almost the same amount as the S&P during those bad years, but during the good years, we completely dominate the S&P.
Right. And that's, I think, the most important thing. Obviously, for those that maybe don't know, Aries is a long NASDAQ, utilities, healthcare, and bonds strategy that goes back to 1991. And it's weighted 80% within the RQF, the Radar Quant Fund. And the other 20% is the Astraeus model, which is the Bitcoin model, which goes back to 2016. So we start the model here in 2016 for the RQF because that's the earliest data point we have for the Bitcoin section of it. And RQF is 80/20. So we don't want to try and weight something that doesn't exist prior to 2016. So the RQF starts in 2016. Aries obviously goes well, runs well prior to this point, but in the scope of RQF as a whole model, we start in 2016. And these are the returns. And yep, they are pretty stellar. RQF being the orange bar here really does, in 2021 outperforms Bitcoin. In 2019 outperforms Bitcoin. In 2019, 18 and 19 both outperforming Bitcoin. So this is not a model that is heavily dependent on Bitcoin, which I want to make clear because a lot of people will say, "Oh, you have a really high CAGR, but it's because of Bitcoin." And no, it's Bitcoin does assist, but it's not. It doesn't fall on Bitcoin's back. So that's I want to make that clear. But let's dive into what happened this week. So we have the Nasdaq here, the Nasdaq ETF QQQ, finally back above mid vamp for the first time since pretty much middle of the month. So now we're back. We closed above mid vamp, and this is going to be a key point here for us to hold. For those that are following the quant deck and the regime and the signals, you guys understand the regime is favorable for this, for the Nasdaq, and we are in a situation now where we're in a bullish trend. And when we're in bullish trends and prices above mid vamp, the base case is going to be new all-time high or new highs. And in this case, this would be a new all-time high. So as long as we can hold mid vamp here, which is about $503 on the Qs, we should see new highs. And that should be met with an overall rally in risk assets themselves. So this is something that we're just generally watching. for the Nasdaq, and then we have bonds. These are the complete opposite. They are not in a bullish trend. They flipped bearish a little over, a little about a month ago at this point, and they've been just consolidating sideways. I think that a lot of people are wondering, well, do you still think rates are going to go down? Right? I think that's a big question everyone's wondering because we were bull posting the heck out of bonds over here. We got the move. Unfortunately, the the Ares model, which encompasses bonds at the time, didn't accurately capitalize on this. I'm not going to sit here and talk smack. I mean, remember we all took a massive run up and then we ate a bit of a drawdown here. So that's just what happened, right? And we've since improved the risk management within Ares to capitalize on those more sudden shifts in risk dynamics. But ultimately, we closed bonds in the green, profitable trade. Wasn't what we would like it to have been, but it was green. Ultimately, they are now at the point where I think rates themselves have gotten a bit extended. I wouldn't say we are going to go bottom fishing bonds here. We don't like to buy, especially these sectors and these allocations and assets in bearish trends, right? So we don't want to touch bonds in bearish trends here in a bearish trend. But I do think rates themselves have gotten extended. If we take a look at the 30-year, like we can see here that we're all the way up at almost 4.6%. We made a massive rally off the lows from sub 4. I think that there is the possibility now we're getting extended here. There could be a rotation back, maybe towards just 4.1, 4.3 area, 4.123 in this area here, and I think that alone will be very supportive for risk assets.
But I think the environment that we're in right now, it's really about growth. It all comes down to growth. That's what's going to determine these interest rates. And I think we are back in the scenario of bullish should be your base case. Like, yeah, bonds can reverse from here, but at the end of the day, bullish stocks is the base case. Bonds need to prove us that there is a reason to be long risk off assets. And right now, we're just not seeing any proof of that. It's all about risk on at the moment. And that is going to stay that way until there's something that proves to us that there's a reason to be bearish.
Right. Yeah. Like I said earlier, I think touching bonds right now, it's probably a good contrarian play if someone wanted to like take a stab at them because of what's happened the last 2 months in the bond market. But I don't, from a systematic standpoint, it's not something we're touching, right? So other than that, I mean, let's also talk about the elephant in the room, Bitcoin. This thing has been moving and moving like it does, like Bitcoin does, up in a straight line, rocket mode. And I mean, we're almost at 100,000. We've yet to breach it, but we're just about there. I could see this happening in the next day or so at this point. Um, Very powerful move here. We are long Bitcoin from about 70K after going back into bullish trend from this bearish trend action. So we are long Bitcoin. Um, and we're just riding the wave here, right? So it's like the next step here, I think, is we hopefully see some sort of consolidation at some point. We let Momo catch up to the upside, really strengthen the trend, and we continue within the bullish trend higher.
Yeah, so far, I don't think there's really anything that's going to stop Bitcoin until we go back into a risk off regime. That's
Yeah,
really what's going
yeah.
to do it. And in terms of the macro landscape, the only thing that I'm seeing at the moment being a potential catalyst is the whole situation with Russia. But we've got Trump coming into office pretty soon. He's clearly very adamant on stopping the conflict and finding peace. And Putin has also come out and said he's willing to come to peace talks with Trump. So even that catalyst is not a very strong catalyst. And in terms of unemployment, we're seeing the unemployment rate stay steady. Nothing really is going out of control here. It's pulled back a bit. Uh, there's really nothing to be too bearish about unless there's a complete black swan that comes out, but at the end of the day, that's not really something you can trade along. If you're always trading along black swan events, potential events, you're never really going to make money. So, in terms of what we actually see, I don't really see anything that's going to pull us into risk off very quickly. What about you?
I think the only thing that probably is the remaining catalyst here is the NFP print in December, right? So in a couple of weeks, we're going to get an NFP print. And quite honestly, the labor market has shown us that there's a dynamic of resiliency there, right? Where a couple of months ago, we were watching this move rip higher, and rightfully so, the system was positioned for it, and we were in what we would call a risk off regime. But since then, and gradually within the process from about August, we shifted first from risk off to a slowdown regime. So we went from, call it a risk on regime in the spring. We fell into pretty aggressively into a risk off regime, and then we lifted into a slowdown. That key distinction there is what would have helped us capitalize better on the bond trade, but also take more advantage of the equity market moves. And that's a key distinction going forward, which we'll be able to capture. But ultimately, that move to the slowdown there, where you go from risk off to slowdown, that I think was a defining factor in the path of what we're seeing here, which basically allowed the unemployment rate to relieve itself, come back down a bit, and consolidate. Now, the question is, we've gone from a slowdown over the last couple of weeks back into risk on, and that pivot or that rotation up, as long as that holds, the unemployment rate should remain somewhat steady. Now, I do think there are some other dynamics in here that kind of cloud this whole thing, right? So, you do have the Fed that's now it's very apparent the Fed's now debating whether they should be cutting, they should stop the cutting cycle. We've had an immense amount of cuts being ripped out of the market where we're only looking at the Fed dropping rates to slightly below 4% in the next year. So, there's a lot of hawkishness that's been baked into the cake here. And I think that there comes risk with this, right? And this has been our thesis. This is why we were getting so bulled up on the risk off thesis when it emerged, because it almost was like we were getting to that tipping point where it was time to strike, right? It was time to basically unload in the other direction. And it didn't happen. And I think that's, again, we didn't stay in risk off for too long. We were there for maybe 4, 5, 6 weeks or so. And then we rotated back up into a slowdown phase and then further on to risk on. I think that any point that we go to risk off, it's a possibility. Risk on, risk off. There's always a possibility for either. But I think that risk there of the Fed remaining too restrictive is something that is kind of like music in the background. The market has decided that to not be a prevalent issue at the moment. So it's kind of put it on mute, or basically just turn the volume down. It's still running. I still think the Fed is playing a game where they're going to have to cut interest rates now, and they should be cutting a lot more than to 4%. Some people will argue, well, no, there's all these other reasons. And the entire time we were long bonds, we outlined why there is risk here. I mean, even right now, right? The Fed has a 40 basis point window to their central tendency from 24 through 27. So we'll get the dot plots next month. We'll see if that central tendency is lifted or not. But the Fed is right up against the wall right now here with unemployment. So, I mean, all it takes is one or two bad unemployment prints, labor prints, and we're back into risk off. I do think, though, that the system is sharpened enough to the point where we saw it coming last time. We caught this move from where we moved up from 4 to 4.5, and then around there, we caught that major bond rally to the, at least we wrote it up. But I think that if that opportunity presents itself again, the system will definitely see it coming, and we'll be able to position accordingly. But in my mind, the way I gauge this is the unemployment rate, right, is lagging. This is a 30-day delayed data point, right? So we're getting it the month, well, not 30 days, but we're getting the prior month, and by then things have changed, right? So I think the systems will pick this up in real time, and if we have a significant shift here, I'm always going to be focused on the system and take advantage of it that way,
Yeah. Yeah, that's really where it's at. It's just about the system tells us what to do and we just follow it. it's it's kind of funny because like we do get a little bit of hate around our trades, and that there are times where the system tells us to go long when stocks are breaking out at new all-time highs or Bitcoin's breaking out at new all-time highs. And yeah, it may not be the smartest time to long, but whatever the system tells us to do, that's what we do. Like it's got an insane annual growth
I mean, we're
rate.
just trying
So
to we're just trying to replicate this, right? So it's like
yeah, like
whatever it's
we want to be as
yeah.
accurate as possible. Like we're just gonna do whatever this tells us to do.
Yeah. I mean, like I get it. Some people would say like for example, um a big feed or pushback I think I've seen was with the TMF, right? We long TMF somewhere around 46. It went all the way up to like 60 and people were like, "Oh, you sold out for a third of what we should have locked in, right?" And that's just because the system the trends and whatnot, they didn't line up, and maybe I know exactly what it was. We had the risk profile between censoring risk off and risk on was too harsh. We've since modified that. It wouldn't necessarily have improved this drawdown specifically, but it dramatically increases the efficiency of the the risk determining factors going back to back to 1991. So it was a big update for us in terms of the models, but ultimately a lot of people are looking at this like, oh, you didn't lock in up here, and like, yeah, okay, obviously we didn't lock in up there, right? But like at the time, I don't think you would have thought that it would make sense to lock in up there, right? Because that's how this works. Because if you take a step back, I know I might be sounding somewhat chopped up here, but if you take a step back, when you're breaking out of ranges, you want to be long because you don't know where the breakouts are going to end. So, for example, the TMF one didn't work out too well, right? But we look at something like TQQQ at the beginning of the year, right? Or I should say QQQ, sorry, where we break out of the highs here. Like this is a breakout you would have wanted to be long, right? This is a breakout that you want to be long. And to say like, oh, we're up a lot, let's trim it, and then you go up even more is pretty much why most people end up cutting their winners too early. So the system is designed to capture the meat of the move. In this case, my opinion was the TLT move. This was not a real bond move. This was a pump fake. And if it was a real bond move, I think that this would have continued. And obviously, this would have coincided with the onset of a recession, which we didn't get. So we pivoted out of that quickly, back into risk on, and we're pretty much taking it from there. But all in all, major upgrades to the system that I think our members and even us, we're all going to enjoy moving forward. Make it a little bit more dynamic, diversified in the areas of somewhat confusion, or I don't want to say confusion, but the areas of uncertainty. We have a new stage where we diversify between defensives a bit more to capture those bullish equity times, but also bearish, like really like the middle ground between risk on and risk off, which we call slowdown. And ultimately, that I think is going to be really valuable for us going forward through this regime and the regimes to follow. But before I finish the podcast off here, I want to go over MicroStrategy. Now,
Yeah.
for those that don't know, this is Mikey Saylor. He's top G around the streets these days. He's basically he's the new they're treating him like the new roaring kitty. So what is going on with MicroStrategy? And I think a lot of people are wondering, well, I think a big debate everyone's asking themselves is, can I really get long-term leverage from MicroStrategy, right? They're thinking like, okay, I can buy MicroStrategy, basically get the leveraged upside to Bitcoin, and I basically get to leverage Bitcoin, capture excess returns against Bitcoin through a non-traditional leveraged vehicle. So it's not like it's a MicroStrategy is not necessarily a 2 times leverage ETF. It's just financially leveraged through basically accounting leverage, right? That's how this is done. It's not through a derivative or anything like that. I do think that a lot of people are probably wondering, well, man, if I just buy MicroStrategy instead of Bitcoin, what's the upside? What's the downside? What you're doing when you're long MicroStrategy is you're long the idea of exponential Bitcoin appreciation, right? Because without Bitcoin going up exponentially, as it has been doing the last couple of months, right? We're going from 50K to 90K. I think what happens is that balance sheet leverage, it ends up hurting you, because what ends up happening is, you're overpaying for Bitcoin with the anticipation that Bitcoin goes up exponentially from here, and you're getting that leverage capture to the upside, right? And if it doesn't happen, what ends up happening is you kind of get chopped up in the mix. And I think that this is not the traditional, oh, you want to long Bitcoin, just buy MicroStrategy. I think this is a more sophisticated play for someone that is maybe it's the bottom of a bear market type of thing. You want to long Bitcoin. I think it's probably a smart idea to jump in something like MicroStrategy with the anticipation that there's going to be offerings along the way and leverage up on the run up. I think like when we're in this area, I'd probably say that at least asterisk, our Bitcoin model is always going to trade spot Bitcoin. We're not leveraging it, and we're not trading MicroStrategy instead of Bitcoin for various reasons. I mean, all it takes is Bitcoin to slide 10-15% from here, which, to say it's not possible, come on, right? Come on, it could happen. And MicroStrategy gets whacked. And I think that to run this in your account as a Bitcoin proxy, I don't think that's a smart idea. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.